Let us take up question number 13. Let us read this question. Sun Moon Mutual Fund, that is an approved mutual fund sponsored open-ended equity oriented scheme, Chanakya Opportunity Fund. There were three plans, that is A, dividend reinvestment plan, B, bonus plan, and C, growth plan. At the time of initial public offer on 1/4/1995, Mr. Anand, Mr. Bachchan and Mrs. Charu, three investors, invested rupees 1 lakh each and chosen B, C and A plan respectively. Further given, the history of the fund is as follows. Now you can see in the question, they have given date-wise history of dividends, bonus and the net asset value of each of the three plans at the different dates. It further says on 31st July, all three investors redeemed all the balance units, and further they are asking you, calculate annual rate of return to each of the investors. Consider long-term capital gain is exempt from income tax. Short-term capital gain is subject to 10% income tax. Security transaction tax 0.2% only on sale or redemption of units, and ignore education cess. Now friends, you will have to practically solve this question 3 times. Why? Because you are going to deal with 3 different plans. That makes the solution little bigger, and 3 different plans have to be dealt with differently. Furthermore, I'll have to keep shuffling the screen from the question part to the solution part, so that you can keep track of what exactly I'm referring to in the question and how the same is placed in the solution. So we are going to first start with plan A, that is dividend reinvestment plan, and for that purpose, first let me take you back to the plan so that I give you initial explanation regarding this. Now see, the first time the dividend declared on this plan is on 28 July 1999, and the dividend rate is 20%. So dividend will always be given on the face value. So don't forget, face value of each of these units is given as rupees 10, correct? Face value is rupees 10 and 20% dividend would mean rupees 2 per unit as dividend, and whatever be the dividend received, the same will be reinvested on the same day, because the name of the plan is dividend reinvestment plan. So as a result, the NAV prevailing on that date will become the basis for making the dividend reinvestment. So friends, what I will do is, I will explain you the calculation as on 28 July and with 20% dividend. Then I'll explain in detail one calculation further, that is on 31st March 2000. Once I have given you couple of calculations over here, you should be able to deal with the remaining ones. So let us see how to present the solution. We have to first deal with plan A. So dividend reinvestment plan, first we'll have to calculate the total units accumulated by end of the holding period. So what I do is, I would make up a table, date, NAV, dividend, additional units and cumulative units. So first what has happened on 1/4/1995, the opening date, the NAV was 10 because that was the new fund offer. The units were issued at their face value. Obviously at that date there was no dividend. Additional units were the original units purchased, because the amount invested is 1 lakh, number of units 10,000, and 10,000 into 10 will give you in total 1 lakh rupee as invested. So additional units which were acquired on this date. Why I am saying additional? Because every time you have some additional units, that incremental quantity will go on adding up to the existing units to arrive at the cumulative units. At present, before this date, the cumulative units were 0. So whatever new units you have acquired on 1/4/95 have been considered as additional units, and the same has been now included in cumulative unit column also. Now the very first date where the dividend was declared, you have to focus on that date. I explained you along with the question earlier that it is 28 July 1999. NAV on that date was 30.70. As per the question, the dividend is 20% and dividend will be on the face value. Face value is rupees 10. 20% of 10 will be rupees 2 and 2 rupees of dividend will be given for each unit, and there are in total 10,000 units, correct? So 10,000 units multiplied by dividend of rupees 2 per unit will give you total dividend of 20,000. Once you get dividend of 20,000, you are not going to receive this dividend in cash. This dividend will be reinvested as per the NAV prevailing on that date. So this dividend, when it is reinvested, the additional units that will arise will be 20,000 divided by 30.70, which will give you 651.4658 units. Now friends, one thing, units of mutual funds can be traded even in fractional quantity. So don't think of rounding off this quantity. Practically, in reality also, units of mutual funds can be traded in fractional quantity. So we had already 10,000 units. We got 651.4658 units by way of dividend reinvestment, and then the cumulative units will be 10,000 plus this 651.4658. That makes it 10,651.4658 units. So friends, let me do one thing. Let me now take you back to the question so that we can identify what is happening at the next date. So friends, here I bring forward the question once again in front of you. Try to understand one thing. We find that 31st March 2000 is the next date of dividend. Rate of dividend is 70%, right? So 70% on the face value will be rupees 7 per unit as dividend. Ignore other information about bonus ratio because this bonus ratio will not apply on plan A. Plan A is purely dividend reinvestment plan. We have nothing to do with this column. We will deal with this bonus ratio column when we deal with bonus plan. So right now the relevant information is only this 70% dividend. This will make dividend per unit as rupees 7, and that 7 will be applied on the previous cumulative quantity. So let us move ahead and go back to the solution. Let me show you back the solution screen now. Alright, so this was the last thing what we have done. Now let us come to the next date, that is 31st March 2000. NAV on that date is 58.42. Now dividend will be at the rate of rupees 7 per unit, and 7 per unit multiplied to 10,651.4658 would give you rupees 74,560 of dividend. That dividend divided by the NAV prevailing on that date will give you the additional units that will arise on dividend reinvestment. These additional units added to these cumulative units will give you the final quantity of cumulative units as 11,927.7410. So friends, these are the cumulative units as on 31st March 2000. Now what I want from you is, you should write down this whole thing with complete understanding once you have made the completion of this table. So now you may check back. The next dividend date is 31st October 2003. And on that date the NAV is reported as 42.18. The rate of dividend applied on the face value will give you the dividend per unit, and dividend per unit multiplied to this total cumulative units will give you total amount of dividend, and that total amount of dividend comes to 47,711. Now this dividend will again be reinvested at NAV of that date, that is 42.18. So this dividend divided by the NAV on that date will give you additional units. These additional units will be added to these cumulative units of earlier date, and the cumulative units as on this date, that is 31st October 2003, will be 13,058.8695. The next date of dividend is 15th March 2004. Whatever be the dividend rate, it will be applied again on the face value to get dividend per unit, and per unit dividend will be multiplied to the last cumulative quantity to arrive at this total amount of dividend, that is 32,647. This 32,647 will be the dividend which gets reinvested at the same date, and this dividend reinvestment will be at the NAV prevailing on that date. So to find the additional units, what you will again do is 32,647 divided by NAV of that date. It gives you additional units as 702.8418. These units added to the previous cumulative units will give you 13,761.7113 units. Finally, we find that last dividend will be on 24th March 2005, and that dividend, whatever be the rate of dividend applied on face value, that dividend will be multiplied to the cumulative units. So first you find the dividend per unit, multiply that to the cumulative units, and you get the total amount of dividend. Total amount of dividend when divided by NAV of that date will result into the additional units. Once you get additional units, add these additional units to the cumulative units, and you finally get the cumulative units as on 24th March 2005. Don't just copy everything. Once again, if required, you may calculate, you may check all the calculations, read the question, look at the solution, understand it properly, and then write it down. I am giving you a lot of time. Utilize it and note down properly. Alright friends, you would have finished writing this whole thing. Before I take you ahead, let me explain one thing. This was the last dividend payment date and through which these additional units were acquired. Now all these units, 14,906.1396 units, which are cumulative as on this date, all these units were sold on July 2005. Now what will happen? Short term capital gain and long term capital gain has to be understood here very well. Now for securities, you know one thing, that holding period less than 1 year, it will be attracting short term capital gain, and holding period greater than 1 year will be classified as long term capital gain. This is with respect to investment securities. Now if you could see, before 24th March 2005, the earlier units were acquired on 15th March 2004. Now 15th March 2004 to July 2005 will definitely be a period longer than 1 year. That means all these units up to 13,761.7113 units, all these units were held for more than 1 year before they were sold. Only this last quantity, which we have purchased on 24th March 2005 and sold on July 2005, this is the only quantity that was held for short term, which will attract short term capital gain and tax thereon. So let us do one thing. Let us first understand the computation of that short term capital gain and tax thereon. So short term capital gain will be with respect to the sale proceeds of those last units, 1144.4283 units. These were sold at 53.75 per unit. This 53.75 per unit is the NAV prevailing on the date of sale. From this, you are going to subtract the cost of units. Cost of units will be NAV on that date on which you have purchased these units, correct? So cost of these units was 55,047. From the sale proceeds, subtracting the cost, whatever be the difference will be short term capital gain, and the tax on that short term capital gain will be at 10%. So 10% of the capital gain amount will be the short term capital gain. Now friends, one thing I would want to warn you, if you look into the solution given in ICAI suggested answers, while deducting the cost, they have also deducted security transaction tax for computation of short term capital gain. However, if you read income tax law, currently the situation is there will be no deduction of security transaction tax allowed for computing short term capital gain. As a result, it will be wrong if you subtract security transaction tax for computation of short term capital gain. For that small difference, solution that I am showing you over here will not match with the solution given by ICAI in their suggested answer. What they have given over there is incorrect. At the end of the solution, I will give you an explanatory note in this regard. However, I want you to strictly follow the solution that I am recommending over here. So please take note of this working also, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now finally determine the annualized rate of return on plan A. So this is going to be very simple. Total realization will be all the units sold at the NAV prevailing on the date of sale. This is the total realization. Obviously, to find the net realization, you will subtract the security transaction tax as well as you will subtract tax on short-term capital gain. Now, two things very important. For computing net realization, definitely you will subtract security transaction tax, but for computing short-term capital gain, you are not supposed to subtract security transaction tax. That thing you have to understand very well. Now, holding period will be in total 124 months. That is 10 years and 4 months, correct? 10 absolute years, and then last 4 months, that was April to July 2005, was additional 4 months. So 10 years plus 4 months will give you 124 months. Now, to compute rate of return, it's very simple thing. Original money invested by the investor was 1 lakh, and the final net realization you can see over here 7,98,956. So you find the overall rate of return by taking 798,956 minus 1 lakh divided by 1 lakh into 100. But this will be holding period return, which is 124 months. For annualization, you multiply 12 by 124 and your per annum return comes to 67.64%. So friends, please take note of this, and that will be end of plan A calculation. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up the calculations of plan B, that is bonus plan. Calculation of total units accumulated by end of the holding period. Now this is much easier, correct? So here date, bonus ratio, additional units and cumulative units. So here there is nothing like dividend reinvestment. Whatever be the bonus ratio informed, accordingly the units will arise. So originally on 1495 the units fresh purchased on the new fund offer were 10,000 units which were added into your stock, and now the first time bonus was declared on 31st March 2000, and on that date the bonus ratio was 5:4. 5:4 means 5 bonus units for every 4 units held. So there were 10,000 units. 10,000 into 5 by 4 will give you 12,500 as bonus units. Those units added to the original cumulative units will give you final cumulative quantity as 22,500 units. Then next bonus date is 31st March 2004. Bonus ratio is 1:3. That means 1 bonus unit for every 3 units held earlier. So if you are holding 22,500 units, 1/3 of that will be given to you as bonus, and so additional units obtained by bonus units will be 7,500, and cumulative units come to 22,500 plus 7,500, that is 30,000. The last date on which bonus was declared is 24th March 2005, where bonus ratio is 1:4. So 1/4 of 30,000 units will give you 7,500 units, and that added to 30,000 will give you cumulative units finally as 37,500 units. So friends, before I take you further, please take note of all these calculations, and I am sure you easily understand the calculation of bonus units based on the bonus ratio informed. So quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Now what I want you to understand is, even in case of bonus plan, the units that had been in hand for less than 1 year before sold, that means I am talking about these units. See, all these units were acquired earlier. Do you see the last date on which these units were acquired was 31st March 2004. If these units are sold on July 2005, it will result into long-term capital gain, which will definitely not be considered over here. However, this last lot was acquired on 24th March 2005 by way of bonus, and that quantity will attract short-term capital gain when sold. So 7,500 units will be considered for short-term capital gain. So let us proceed ahead and now write up the short-term capital gain working and the tax thereon. So gross realization will be those 7,500 units into NAV on the date of sale less cost of bonus unit. Because it is equity oriented mutual fund, cost of bonus unit will be taken as 0, which is again not correctly given by ICAI in its suggested answers. If you read ICAI suggested answers, they have given the cost of bonus units as NAV prevailing on that date, which is not correct. You should always take the cost of bonus units as 0 because it is particularly equity oriented mutual fund. So your net realization will be your short term capital gain, because no cost is being deducted. You got these units for free. So the short term capital gain is the entire amount of net realization, which is 1,72,350, and tax will be 10% on that short term capital gain, that is 17,235. So friends, take note of this calculation also, and then we move ahead. Alright friends, you would have finished writing this working. Now let us move ahead and now calculate the rate of return on this plan B. This is going to be again a simple working. So you find the gross realization, from that you subtract STT and subtract tax on short term capital gain, and what you get is net realization. And the initial investment was still 1 lakh and the holding period is still 124 months. So exactly the way you computed rate of return for plan A, same way you will compute for plan B, only the values are different over here. So friends, do one thing, don't just copy the figures, understand and write down. I'm giving you a lot of time to do so. Alright friends, let us move ahead and now take up the third plan, that is growth plan. The growth plan is going to be very simple. No change in units, only the NAV changes. So total realization will be 10,000 into 82.07. Because there are no units which have been purchased in between, there are just the same number of units that you have originally acquired. Holding period of this unit originally acquired was even more than 10 years. So there is no question of short term capital gain. So subtract only STT and you get the realization after tax. That is of course realization after STT, and that is 8,19,059. And then simply compute the rate of return in the same style as you did for the other two plans, and the final answer over here is 69.59% per annum. So friends, take note of this calculation also, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. So the solution is definitely completed, but I have to give you two important notes over here. I have already explained you. Please just write up these notes. And once you write this, we move ahead with the next question.